trillions of dollars in liquidity are quietly bleeding out of traditional exchanges and clearinghouses right now, not because of a crash, but because of something far more structural. High-frequency firms and institutions are pulling collateral from places like the NYSE and LSE to feed venues that can settle in real time. The old T+2, or even T+1 world is starting to feel like using a fax machine in the age of instant messaging. Major players, BlackRock, Goldman Sachs, JPMorgan, and others are integrating private ledgers directly with public liquidity pools through tokenization. On-chain order books are evolving fast enough that deterministic, code-enforced execution is becoming competitive with centralized systems. This isn't hype about crypto replacing Wall Street. It's a liquidity migration driven by cold, hard efficiency. Today we're breaking down why it's happening, how far it's gone in 2026, and what it means for the next supercycle of capital flows. You are watching the Signal and Noise podcast. Make sure to like and subscribe as we analyze with no emotions or bias, just raw data analysis, pointing towards the signal and dispelling the noise. This is not financial advice. Do your own research. Traditional securities settlement has long relied on netting and delayed cycles, historically T+2, recently improved to T+1 in the US, effective 2024. This works because massive netting reduces the actual cash and securities that need to move. But for firms that need instant capital turnover, especially high-frequency traders, market makers, and institutions managing dynamic collateral, even T+1 creates friction. Capital sits trapped in siloed clearing and banking systems between trade and settlement. That trapped liquidity has real costs: opportunity cost, funding expenses, and reduced ability to redeploy capital quickly. In volatile or high-volume periods, these frictions compound. We're already seeing signs of liquidity moving toward more efficient rails. Tokenization and on-chain systems promise real-time or near-instant settlement for tokenized assets, better collateral mobility, 24/7 substitution, automated margining, and composability across protocols. DTCC's own tokenization service, with limited production trades starting around July 2026 and broader launch targeted for October, is a clear signal that even core infrastructure players are building the new rails. This isn't collapse, it's competitive pressure. Venues and systems that offer faster, more efficient settlement attract flow. On-chain order books, especially central limit order books, CLOBs, on advanced Layer 2s and emerging Layer 3s are maturing rapidly in 2026. Scaling improvements have brought execution closer to the speeds institutions demand, with some optimized setups achieving very low latency. True sub-millisecond remains more aspirational or hybrid for now. The key contrast: centralized exchanges often rely on probabilistic or internal matching with potential for latency, information asymmetry, or discretionary elements. On-chain deterministic systems execute via transparent smart contract code. Once conditions are met, the outcome is predictable and verifiable by anyone. No hidden middleman can alter or delay it. Removing or reducing the broker-dealer and traditional intermediary layer cuts the latency tax, the cumulative delays, fees, and frictions that have historically benefited large integrated players. On-chain, matching can be open, permissionless, or permissioned where regulated, and composable with other protocols. Liquidity providers and market makers can interact directly with the order book. This levels the playing field. Major institutions are no longer just experimenting, they're building production capabilities. BlackRock's BUIDL Tokenized Treasury Fund on Ethereum allows institutions to hold tokenized exposure that can serve as real-time on-chain collateral. Goldman Sachs has been active in tokenized money market funds, while JPMorgan's Onyx supports collateral transfers, repo, and more. DTCC's 2026 tokenization pilot includes BlackRock, Goldman, JPMorgan, Vanguard, NYSE, and dozens of others tokenizing stocks, ETFs, and treasuries for real transactions like collateral movement and repo. The shift from permissioned testnets to handling meaningful institutional volume on, or bridge to, more open rails reflects clear incentives. Faster settlement and collateral mobility free up capital. 24/7 operation matches global needs. Market makers often see better economics through direct participation and lower overhead compared to legacy intermediary chains. This is integration more than abandonment. Many firms are building hybrid capabilities or parallel on-chain rails while maintaining legacy systems. On-chain transparency fundamentally changes market structure. In opaque, centralized systems, there can be information asymmetry, large players potentially seeing flow before it hits the market. On-chain order books, trades, and liquidity are visible. This reduces certain forms of front-running or hidden advantages, though new challenges like MEV exist and are actively mitigated. We're seeing a move from black box algorithms to more open or auditable liquidity provisioning. Protocols increasingly offer liquidity as a service, deep, programmatic depth supplied at the protocol level. This doesn't eliminate the need for sophisticated liquidity providers. It changes how they operate. Open source strategies and direct protocol incentives attract a broader set of participants. Looking ahead, tokenized and on-chain rails are positioned to capture an increasing share of global asset volume, especially in RWAs, collateral management, and cross-border flows. Forecasts for tokenized assets consistently point to significant growth in the coming years as infrastructure matures. Not every asset class or trade will move overnight. Legacy systems have deep liquidity and regulatory embedding. A hybrid world is the most likely near to medium-term outcome, tokenized versions running alongside or integrated with traditional rails. For investors and participants looking to position for this migration, watch protocols and layers building robust CLOBs, intent-based execution, and strong liquidity incentives. Focus on infrastructure enabling tokenized RWAs with real institutional adoption. Monitor traditional players' on-chain activity, tokenized funds, collateral use, and order book integrations. Prioritize venues demonstrating sustainable liquidity depth and risk management. The broader shift is from manual, coordinated financial plumbing to more autonomous, global, code-driven market efficiency. Capital flows to where it can be deployed fastest, cheapest, and with greatest certainty. This migration brings real benefits, but isn't without hurdles. On-chain systems must meet institutional standards for privacy, resiliency, scalability, and regulatory compliance at massive volumes. Liquidity depth in many tokenized venues still lags traditional markets. Regulatory clarity continues to evolve. Claims of a complete or immediate death of traditional exchanges overstate the case. On-chain brings its own complexities like MEV mitigation and smart contract risk. The right framing is competitive evolution and hybridization. Institutions are adopting on-chain capabilities because they solve specific pain points. DTCC's tokenization work and major banks' pilots show pragmatic progress rather than revolution. Success will depend on continued infrastructure improvements, regulatory frameworks that support innovation, and venues that deliver reliable liquidity and execution. The great liquidity migration is underway, driven by the relentless pursuit of efficiency in settlement, collateral, and execution. Tokenization and maturing on-chain order books are giving institutions new tools that legacy systems struggle to match. Traditional players aren't disappearing, they're adapting and integrating. The winners will be those building the rails that capture this migrating capital while managing risk effectively. For investors, understanding the flows, incentives, and infrastructure layers is key to navigating what comes next. What do you think? Are we on the cusp of a true on-chain liquidity supercycle, or will hybrids dominate for longer? Drop your thoughts in the comments. If you want more on tokenization, institutional adoption, on-chain infrastructure, and market structure evolution, subscribe and hit the bell. What do you want us to discuss next? Do you want us to talk about how programmable transparency reconstructs global credit, or why institutional secondary markets are migrating to privacy-preserving zero-knowledge order books? This is Signal and Noise. Liquidity follows efficiency, and the map is changing fast. Stay sharp.